Hi everyone, I'm back with another video in my YouTube series, 10 Common Wall Street Misconceptions. I apologize that there was a significantly long break in which I didn't record anything, but I was unfortunately in the hospital for some personal issues that I was having, and as soon as I got out, I wanted to go back and continue to do what I've been doing. So this sixth video is going to dispel the myth that technical analysis, which is the study of market timing, is more important than fundamental analysis, or the study of accounting statements. In Wall Street, there are a lot of people who would try and pick a particular camp. They're either a fundamental analysis, or a fundamental analyst rather, or a technical analyst. They'll decide to look at the squiggle patterns that stock prices make and indicators that study what price is doing, or they'll spend the majority of their time focusing on fundamental analysis, which is the study of profit relating to the cash conversion cycle of accounting statements, which I'll delve into further in later videos. You'll see that people like Warren Buffett, almost everything that he writes is centered upon the beliefs of fundamental analysis, that as long as you follow the profit, that you'll be able to make a lot of money. Whereas some investors, for example, Peter Lynch, who was the senior manager of the Fidelity Magellan Fund, actually referred to technical analysis as the study of squiggles because he frankly didn't believe that there was much science to it at all. But that's really because he was one of the best people in regards to their ability to break down accounting statements or to study fundamental analysis, and came up with a particular method that worked for him. Now, I'm not going to say that you should only look at fundamentals or only look at technical analysis, because I think that both are connected to each other, because technical analysis, the study of price, and fundamental analysis, the study of profit, really do go hand in hand. As Warren Buffett pointed out, that price is what you pay, value is what you get. But before you can determine what you should be paying for something, you need to recognize what the underlying value is for what you're buying. So, first, I'm going to talk about sort of the different styles of approach that people have. Technical analysis determines when you buy, whereas fundamental analysis determines what you're buying. The way that I would think of the stock market is that in the short term, it's a lot like a beauty contest. And this metaphor was actually used in a lot of Keynes's writing, who was arguably one of the most important economists that the world has ever seen. He saw it as, you have a basket of maybe 6 or 10 stocks, and you pick the one that looks the most attractive. But over the long term, it's not the beauty contest that determines what actually makes money. It's profit. It's the bargain hunt, as he puts it. That over the short term, people are concerned with popularity, but over the long term, people are concerned about profit. And it is my contention that as long as you stick with the corporations that are consistently profitable quarter after quarter after quarter, that you're going to be aligning yourself with the corporations that maybe they aren't particularly popular now, but because profit is the most important thing in Wall Street in terms of popularity, that as long as corporations continue to make cash, they might not be winning the beauty contest now, but they will definitely win the bargain hunt in the future. However, when we look at the beauty contest, we can recognize that you really don't know how long something is going to be perceived as popular, and because the way that people perceive corporations or hot stock tips, they're going to want to get in to get the hot October stock tips before they dump everything and then put it into the November stock tips. But the problem is that it requires a very active lifestyle to only rely upon technical analysis. Whereas with fundamentals, since a lot of these ratios really only get published once per quarter, that you don't really have to spend as much time studying profit, and you don't have to worry about missing some kind of major opportunity because you're only investing in the profit. That most likely the profits are going to be here next quarter or the year after, or 5 years, 10 years after, as long as you find a corporation that is building a significant track record of profit. So there are a few tools that I want to talk about that people really rely on heavily for technical analysis. The first one is moving averages. Now, a moving average is something that you basically take the mean or the average of where the price is closed over a specified time frame. It's very common for people to use the 50-day moving average, which is just a marking of what the average price has been over the last 50 days. or to use the 200-day moving average, which is a compilation of all of the averages that it has created at close over the last 40 weeks. And usually it's considered to be on an uptrend if price is above the 50-day moving average and or the 50-day moving average is above the 200-day moving average. But the problem with moving averages is that you don't necessarily have to rely upon a specific time frame. There are some people who might prefer to use the 40-day because it gives that little bit of more recency that they'll be able to recognize a trend before everybody who's looking at the 50-day. Whereas some people might want to make sure that the trend is really confirmed before they jump in. So they'll change the moving average from 50 days to 60 days. There really isn't a uniform way to measure when something is on an uptrend or a downtrend. But I would say that looking at price's relation to the 50-day moving average and the 200-day moving average, or the 10-week and the 40-week, is usually the most common. Secondly, another major tool that people look at is the relative strength index. And the way that I would explain the relative strength index is that it measures the balance between buyers and sellers. I also like to think of it sort of like the pull numbers of a stock. That when the relative strength index is 50, 50% of people are buying, 50% of people are selling. And that usually leads to prices being stagnant. But if you want to buy stocks at their low point and then sell them at their high point, you want to figure out when they reach that point of maximum pessimism. So when their poll numbers drop, or the balance between people who are buying and selling drops to below 30, that's usually considered to be significantly oversold territory. And when everyone else is selling, that's when you should be buying. Whereas the inverse of that is that once you've bought it when it's below 30, you usually want to wait until it reaches a moment of hysteria, or a moment where it's significantly overbought, which is usually considered territory where their poll numbers or their RSI would be above 70%, to where more than 70% of people who are trading the stock are going to be buying it versus less than 30% who will be selling it. And by looking at that balance between buyers and sellers, that you can sort of get an idea of when you can buy at a point of maximum pessimism and then sell it at the point of maximum optimism. However, that doesn't necessarily happen very frequently. It does usually require a few months for you to see major changes. It can happen in a few days, but if you're only going to be trading on the relative strength index, there are a lot of companies that everybody is buying that don't have any value behind them, or things that people are selling just because of what they heard in the news. But that doesn't mean that you actually should sell it if it's continuing to make a profit. Maybe it's an insider who is selling off major shares so then they can get more people involved in the business. You really never know the exact reasons why people will buy and sell. And the last indicator that a lot of people use in technical analysis is the study of volume bars. What volume bars tell you is how many more people are trading each day. So the idea is that if you can see a stock to where it's averaging a certain amount of volume or a certain amount of shares that are being traded each day, and you see a major jump, that usually means that there's a major peak in interest. But that doesn't mean that people are interested in buying or selling, that it needs to be looked at alongside the moving averages and alongside the relative strength index to measure what direction the trend is going and whether the trend has either hit a high point or a low point that is usually going to be indicative of a reversal. But every single stock that you look at is going to have all of these indicators. And just because something is at its point of maximum pessimism doesn't mean that it's profitable. You want to make sure that you are buying what's profitable and unpopular, where the stock price is lagging behind and the value is taking off. It's skyrocketing, that they're making a ton of money and people really aren't that interested right now for whatever reason. That basically you want to invest like a hipster, that you want to invest before it's cool, and then as soon as it becomes mainstream, that's when you dump it. But there are still more things that you have to look at. Profit is king on Wall Street. I don't care what business it is or what they do. If they're going to be out earning all of their competitors, they'll demand attention. That a lot of people are just trying to look at what other people find interesting and they're trying to chase the trends, whereas it's your responsibility to make the trend. You don't want to follow the sheep, you want to be a wolf. And you're going to jump in and you're going to take those stocks that other people are selling off because they don't understand how profitable the business is. The stock market is very much a waiting game. And as long as you understand that you have to study profit before you can cash in on trying to follow trends, that first you determine the what based off of profit, and then secondly, after you've determined the most profitable companies, you study their price action so you can know the exact moment to buy and the exact moment to sell. So because fundamentals or the study of profit should come before you decide to make decisions based off of timeliness, as long as you understand the relation that each form of analysis brings you, that you've determined the what with fundamentals or profit study, and then you study price action through technical analysis to determine when you should be getting in and out, then you can recognize that they play probably more of an equal part and they're sort of codependent on each other. However, fundamentals are going to be a prerequisite to technical analysis, which is why I consider it to be more important. Thank you for watching this video. Be sure to check out my previous videos as well, and I'll be coming out again soon with the next video, which will be titled that market appreciation means you can ignore dividends. That will be the next myth that I will dispel. Thanks again, and hope you all have a wonderful day.